Volatility and sentiment. Another strategy for analyzing the behavior of the uninformed market participants is looking at volatility. Volatility is a measure of amount by which a security price oscillates, usually about its mean, without regard to its trend over a specified period. The most common calculation for volatility is standard deviation about the mean. The 100-day volatility, for example, is the amount by which a security oscillated over the past 100 days about its mean. Volatility is mean reverting, therefore, when it gets out of alignment with what it has been on average, we can assume that it will return to its mean. Thus, implied volatility is volatility implied by option traders in their pricing of options in marketplace. Implied as well as historic volatility correlates to some extent with market prices. High volatility tends to occur at periods of stress, emotion, uncertainty, fear, and nervousness, most often peaking at panic bottom. On the other hand, low volatility seems to occur during market rises and market peaks when emotions are calm, content, and relaxed. By looking for extremes in the implied volatility, then, because implied volatility expresses the expectations of those option traders, we can determine market emotions. So, VIX is the most common measure of implied market volatility and its predictive ability. So, basically, volatility is change in the prices over a certain period. Polls in market. One way to measure the sentiment of market participant is simply to ask the players if they are bearish or bullish. Although this might appear to be most straightforward way of gathering information about expectations, sampling problems, and other biases associated with poll taking exist. Poll gather information and measure the sentiment of uninformed investors. Several different companies collect and publish sentiment information based on poll.